All right, so we have a quote, outperform moments right now. Now we're going to go back to we don't have a speaker today, so we have our market outlook, our mergers and acquisitions and economic perspective, as well as a sweet spot at the end. So we're gonna change it up something different. You know, most of us are probably finance majors. All of you guys finance majors, I'm assuming. No, so maybe some of them not. All right, this is an interview question that you might see whenever you're interviewing. To ask, I'm going to say it right now. Then you guys can talk with your peers and kind of see what the answer is, and we'll come back in like 2 or 3 minutes and figure out what you guys thought it might be the answer. And I'll explain the answer to you guys as well. So if you could use only one financial statement to evaluate the financial state of a company, which would you choose? All right, I'll give you guys two minutes or so to kind of discuss this with your peers. What did some of you guys think was the most important financial statement? Okay. Anyone else? Money. That's not a statement. All right. Balance sheet. They said balance sheet too. What about you guys up there? Cash flow. All right. So it is a cash flow statement. The reason is that the balance sheet shows a snapshot of the assets and the liabilities in a point in time, and then the income statement shows non-cash expenses like depreciation that will mess up the certain the values of the revenue. So cash flows, you want to know what's coming in the company and what's going out of the company. So the cash flow statement is the most important. It shows liquidity of the company. So cash flow statement is the answer. I got this quote: "No one can forecast the economy with certainty." Right. This is probably one of the best quotes in the past year, because I think in last year, a bunch of economists said they were going to be in a recession within 12 months. It's been 12 months and we're not in a recession. So obviously, we don't know what the future holds. You can't predict the future with certainty. All right, outperforming moments. We get 1 or 2 outperforming moments today. Anyone?
I got a call for an interview with Magic Bank.
All right. Awesome. All right. A lot of people said internships last week, a few weeks ago. So we got a lot of interviews coming up. If you guys need help with those interviews, or want to know how they got their internships, I'm sure she's open to talking with you guys. So feel free to come up to her. This guy now. Okay, cool. We'll start with market outlook. All right, so
hello. Yeah, it works. Okay, so let's get started with market outlook. Today we're going to be talking about the U.S. indices, bad day for stocks, right? And then commodities, heat map, and earnings season. Then we're gonna dive deep into J.P. Morgan, Wells Fargo, and BlackRock. So today the U.S. indices, they were all down. Why? Does anyone know? Anyone? Okay, they were down because the 10-year Treasury went up by 10 basis points, so now it's closer to 5%. The S&P was 4,314.60. The Nasdaq was 13,314.30. The Russell 2000 was 1,728.81. Let's go commodities. The 10-year Treasury yield is at 4.91 now, so it's closer to the 5% that investors are scared of. The oil is 87.14 per barrel, and it's down 0.50% since yesterday. Why is that? The barrel is going down because the U.S. is trying to release the sanctions that it has towards Venezuela because of the Middle East conflicts that there is right now. The gold is at 1,948.29. And let's go into the next slide. So this is the S&P 500 sectors year to date. the best performance was the communication services at 39.79%. Technology was 31%. And as you can see here, consumer cyclical was 18.35, energy 8%, industrial 4%, financials 2%. They were hurting by the interest rates, but we're going to talk more about that today. The basics materials are -1%. Healthcare is -2%. Consumer defense is -6%, and real estate is -9%. Utilities are the worst performing to year to date at -15%. So there might be some great chances to invest in some of the worst performing ones. You just have to look really deep. The earnings season, why is the earnings season important? So on Friday, we had Wells Fargo, BlackRock, JP Morgan report, and then Monday we had Charles Schwab, and then Tuesday, Bank of America, Goldman Sachs, and today we had Netflix and Tesla. Tesla missed the earnings by a lot today. And so why is this important? This is important because they're setting the tone for the week 2, week 3 of the next earnings season. And so based on the performance this week, investors are either going to be more bearish or more bullish. JP Morgan's earnings. The stock price of JP Morgan is 145.91. The revenue was 39.4 billion expected versus the 39.87 reported, beating by 1.20%. The earnings per share was 3.97 expected versus a 4.33 reported, beating by 9%. The net interest income of JP Morgan was up 22.9 billion. It's up 30% or 21% excluding First Republic. As you guys remember, First Republic was acquired by JP Morgan when the bank crisis was happening. So what is the net interest income? The net interest income is one of the metrics used to evaluate the banks and how well they are, how much interest they're getting from the loans that they lend, right? And so in other news, we have the CEO, Jamie Dimon, warning of this despite solid earnings for JP Morgan. He says this may be the most dangerous time the world has seen in decades as the bank continues to prepare for a broad range of outcomes. That was in the results. So one of the reasons that the big banks like JP Morgan, Wells Fargo, that they're performing good is because when we had the crisis of the regional banks, the depositors were scared, so we had the bank runs, right? They were taking out the money from the regional banks, and then they were putting the money into big banks like JP Morgan. So now the JP Morgan has more deposits, and then they have more deposits to lend, right? So the more deposits, the more money they have to lend. And at current interest rates of 7%, their margins are like way bigger. So they don't have to pay depositors almost nothing, but the ones getting the money from them have to pay them back at interest rates of 7%. So this is JP Morgan's income statement, and JP Morgan is a universal bank. They do consumer and community banking, corporate and investment bank, commercial banking, asset wealth management, and corporate lending. So that's how they get their net revenue at 39.9 billion. And then they subtract net revenue minus pre-tax income, then you get the net income. And so their expenses are going into compensation and benefits, occupancy, technology communications, professional services, marketing, and other expenses. So the Wells Fargo stock price is 41.53, and it rose 3.1% following the earnings report. The revenue for Wells Fargo was 20.27 billion expected versus 20.86 billion reported, beating by 2.88%. The earnings per share was 1.24 expected versus 1.48 reported, beating by 50%. In other news, we have that commercial deposits are now stable, so depositors are not scared of banks anymore, and the wealth management for the big banks is on a decline. because as we know, the interest rates are hurting the returns on the stock market. So less people are investing in US equities. Wells Fargo shed almost 50,000 workers under a major cost-cutting effort, but the bank's leadership say that there are more job losses ahead. They're gonna cut off more jobs, and a year ago, the Bank of Wells Fargo shed 6% of its branches nationwide. So this is Wells Fargo and how they performed from February 7 to October 17. They were down 12%. Their stock price is now 41.53. So now BlackRock, and BlackRock is different. Right? So BlackRock doesn't lend; they're asset managers, and their stock price is 616.69. The revenue was 3.97 billion expected versus 4.33 reported, beating revenues by 9%. The earnings per share was 8.24 expected versus a 10.91 reported, beating by 28%. And the assets under management for BlackRock is down 3.4% from 9.43 trillion in quarter two to 9.1 trillion in quarter three. And this is because they're asset managers. So they're the ones that are managing the investments of their clients, right? The big institutions, those are their clients. And now that US equities are down, well, their assets under management went down. And the fees, 78% of revenues are from investment advisory, administration, and security lendings. So now I want to talk about the net interest margin. And it's an interesting one, right? Because the net interest income is how you evaluate the banks. And then you have net interest margin. Right, so you divide by the average interest earning assets, and then you get the net interest margin. But so what I just want to talk about is that the net interest margin has been discontinued by the Fed in 2021, and I was just wondering why, right? So that's one of the questions I have for y'all. Maybe you have to find out and ask me. So feel free to connect with me on LinkedIn, Raul Medina. Thank you.
Hi, again. How are you guys doing? So a little bit what we're going to be covering today is just took a little. I don't remember if you guys remember that poll we put up last time, but a lot of you wanted to cover due diligence. So what we're going to be doing right now is looking at due diligence from specifically an acquirer's perspective. So one of the first things we're going to look at is what is due diligence. So due diligence is an audit or a investigation into a deal or an investment opportunity. So specifically from an M&A perspective, it's going to be basically an evaluation of a company. And its main goal is to reduce information asymmetry between the parties, which I'm sure you guys remember, but for a refresher, that's going to be that gap in knowledge between a buyer and a seller. Obviously, a seller is going to have more information regarding their company. And it's really important for them to be able to bridge that gap. And so then the investor knows what they're getting into. So due diligence really stemmed from the Securities Act of 1933. So you guys remember the stock market crash of 1929, following Black Tuesday. One of the things that they really implemented with this act was having transparency in the financial markets. So this required for them to register with the SEC and provide basic documents for them to have more information and for the investors to know what they're getting into. And for the first thing we're going to go cover is the acquisition strategy. So this is really for the M&A strategy. It's going to be, why are you looking for a company in the first place? So say the acquirer doesn't actually have a company in mind. They're gonna look at some parameters that they're gonna set because there might be other attractive companies that catch their eye, but they really want to narrow it down to which ones are going to be the best for them. So they might want to enter a new market, a new service, provide new products, or they might want to improve their supply chain synergies. They want to maybe get another company, and by acquiring that company, they're going to be able to produce a product that them both separately can achieve alone. And then if you remember for channels, maybe they want to get channel. If you guys remember the acquisition we covered of James Smucker's acquisition of Hostess Suites, the reason that they were looking at Hostess brands that they really wanted them was because they had that channel entry into convenience stores. And for basic parameters, you have geography. Obviously, if you're a domestic, say you want to acquire a company, you're going to focus more a little bit more maybe domestic because you don't want to deal with foreign markets. And also industry market and the maximum acquisition price. You don't want to go over a certain price. Next, we're going to go into the actual acquisition process. So they're going to set a timeline. How long are they willing to spend on this? Because the amount of time that they spend on the acquisition is going to be is also going to equal the amount of cost it's going to take conducting the due diligence. So for a domestic acquisition, that's acquiring acquisition domestically. Some people are optimistic and say it's 2 to 3 months, but realistically, it's going to take 12 months, probably a year. And if you're looking foreign, that's a bigger issue because it could take about 2 to 3 years. An example would be Microsoft's acquisition of Blizzard, which took 20 months because they had to deal with the US, UK, FTC trying to block their transaction because they're trying to do it via arbitrage, which if you don't know what that is, it's basically them purchasing it through through a foreign market. And then after they set their timeline, they're going to develop, if they don't have that company in mind, they're going to develop a list of companies, and that's just companies that fit within their parameters. And usually they'll use intermediaries, so maybe investment banks, private equity firms, and maybe they'll have those connections so they can meet with them directly, or they'll try to contact a company separately. Maybe they'll send a letter to their CEOs. Maybe they'll try to meet the higher ups in an event. It's usually not a letter they send through HR. It's not really a thing that they would do. And to continue it, then we go into the company valuation. So the thing that's different about this is obviously you might skip the step with a privately held company just because you don't have access to those forms, to their financial statements because they're not giving out on the public, just like publicly traded companies. And they'll look at them from an operational and a financial standpoint. And really, it'll include several calls between the two firms, talking about basically giving them the information. And here, maybe at this point, maybe somebody would make a leverage buyout model, which is, if you don't know what that is, it's basically leverage buyout is when a company will go and they'll buy another company on debt, mainly debt. And usually it'll be a debt to equity ratio of 90% debt to 10% equity. And usually the firms will use their assets as collateral. And then for the negotiations, this is where they'll lay the groundwork for their deal. Most deals that don't make it will usually fall through this step. And then finally, when they agree that they're interested in actually going through with this acquisition, the acquirer will send a letter of intent. And that's just a written offer saying, we want to buy your company. These are the obligations you have to do in this contract. And then the acquirer buyer will sign a non-disclosure agreement, and they'll receive a CIM, which I know some of you guys might have been in the analyst program. Remember what that is? That's a confidential information memorandum, which essentially is just like a pitch book for a company saying, this is who we are, this is what we're selling, this is why you should buy us. And I'm not going to dive too deep into it just because, for the sake of time. But this is something like what the table of contents would look like this is the one that we covered that we talked about during the analyst program, the American Casino and Entertainment. And then finally, for the actual due diligence phase. So now that you have those forms, now you can actually do an in-depth, a dive into analyzing the company. So they'll look at their financial statements and they'll usually have a checklist of what they want covered. It'll be a statement. And so we want to look at their revenues. Are the revenues growing? Are the profit margins growing? Is there any solvency issues? What's their liquidation like? And then also, what contracts do they have? What kind of liabilities are you getting from them aside from their actual debt? And then finally, we'll have the purchase sale. And this is all information. They'll finally agree on a price based off the due diligence after they've evaluated it correctly. And then for the integration, that's when the companies will finally start to merge. And then, if you remember, when Santikos came in, the only restructuring they had to do was their CEO, because obviously they didn't need two CEOs. So this is when that's usually when they'll get rid of people. And that's that for that presentation. One thing that I did want to give you guys that I found interesting, if you guys didn't see Mike Strug's, when Mike Strug came to present to us, this is a learning resource that I found, or that he gave us actually. And what it is, it's they have like courses for financial modeling and a bunch of other courses, but they have some that are for sale, and they'll have like flash sales where they're like $15, but they also have like free sources where they have financial modeling. And this is just for you guys if you guys are interested in like diving into those courses, and maybe you don't have time to go to the analyst program. I know today Alex went into a little bit of the financial modeling, but it's just for you guys. And then connect with me if you guys, just want to talk about your careers, where you want to go, stuff like that. I'm gonna go ahead and pass it on to Waylon.
Hello, everybody. Hope you guys are doing well. All right. So, as you guys know, I'm the chief economist here. My name's Waylon. And today we are going to cover the CPI report, the PPI report, the retail sales report, and the inverted yield curve, what it is, what ours currently looks like, such things as this. So to get right into it, the CPI report came out last week or so, and year over year inflation was 3.7% instead of the 3.6% expected. And then month to month, and this is headline inflation I'm talking about right currently, was 4.4% instead of 0.3%. And then in terms of core inflation was 4.1% versus 4.1% right in terms of the expectations, and month to month was right in expectations of 0.3%. So what does this really mean? So whenever you're looking at this, this really tells you that inflation is still not going down. It's either staying the same or it has gone up a slight uptick in terms of, I'm sorry, it was projected to go down more. As you can see there on the headline inflation, it has been going down somewhat, but it's come up recently. And then for core inflation, it's been steadily going down. So why is this important? So core inflation is inflation minus food and gas. So energy prices, that's very volatile. So this would be more of the sticky side of inflation. And so you can see some contributions to this increase was shelter. Shelter is actually over a third of the weighting for CPI data. And so even though it wasn't maybe the biggest increase month over month, as you can see, it's just 0.6. Since it's weighted so high, it did cause the inflation to go up quite a bit. And I'll show that to you guys in 1 second. And then fuel oil went up month to month, and non-energy services went up month to month, and used vehicles went up month to month. But used vehicles is down for the year, as well as fuel oil. So what does this tell us? As I had kind of said, this is inflation being more sticky. So we have an issue of this might be higher for longer indicator here. Just saying that, if inflation is sticking around, we're going to have to keep the federal funds rate high until it goes back down, or even increase rates. So moving on, or not moving on. So here is a index of the components for the CPI report. As you can see, the biggest thing there is shelter. It's 4.4 or 44.4% of the total CPI components. So that's what I meant whenever I said the shelter went up 0.6% month to month and 7.2% year over year. But although that might not be the biggest number down there, it is probably the most important, because that's going to be what is really hurting people, as that is a big part of what people pay in their bills every month. So next is just, and here's a chart from 2000 showing all these different parts of the CPI and just how much inflation we have seen since 2000. As you can see, recently things have kind of gone pretty crazy. especially on the transportation side. So I know a lot of people, if you were looking to buy like a used vehicle or something recently, you've seen the prices have gone way up. Well, there's your chart right there. You can see of the inflation we've had, that one has been a ton. Okay, so the PPI report. So does anyone want to say what the PPI report is? Does anyone know? Producer price index, that is correct. So it's just simply, the last report was the consumer price index. So it's like how much consumers are spending and how much, you know, their budget is going, are they having to pay more for the same things? But this is different. This is the producer price index. So this is more like, hey, I'm selling these goods. Am I having an increase in terms of how much people are willing to pay for it, or are they staying the same roughly? And so, as you can see, year over year inflation for headline for PPI was 2.2% versus 1.6% projected, and the previous month was 1.6%. So it has gone up, as well as month to month is the same thing. It was projected of 0.3%, but instead we had 0.5%. The previous month was 0.7%. So that one did come down somewhat, but the year over year actually came up. And so in terms of the core inflation, that is where you are seeing some really big hikes, as it is 2.8% versus the 2.3% expected and the 2.2% previous month. And month to month stayed the same. You can see in the chart there kind of what I'm talking about. I'm going to blow that up in a second, but some contributions to this increase really was that final goods went up 0.9% month to month. Energy went up 3.3%, and food went up 0.9%. So really we're seeing part of that coming from energy. But that's not all of it, because the core inflation went up, and that is without energy. And so to blow up the chart here, again, this is telling us inflation is being sticky, higher for longer. And you can see in the chart here that we have your total headline inflation kind of in the middle there, but goods and services is on there as well. And then what I was trying to explain of energy. I'm sorry. So this is your goods without food and energy, and services, or I'm sorry, without trade services as well. And then what I'm really trying to show is like why we do core inflation numbers. And it's simply because of, like, if you look on this report, energy just goes up and down, up and down, up and down all the time. And so it's really hard to get a constant idea of where inflation is going. Is it going up? Is it going down? If energy is just causing things to go wild. Even though, yes, this does affect people's pocketbooks, it's also, the thought is energy can come back down fast as it can come up fast, versus this core inflation is separate. It's that sticky part. It won't go away as easy. And so that is why I was kind of showing the chart of, you know, energy, food, such things as these really cause core inflation to be, or cause headline inflation to go wild a lot of the times whenever core inflation maybe doesn't. All right. So one of the most, or one of the biggest reports recently was the retail sales. It was an increase month to month of 0.7% versus 3% expected, or 0.3% expected, which is over double. It's a giant amount. So what this really is saying is that people are still out there buying goods. They're buying Gucci bags. They're buying online, as you can see in the bottom part there. They're going out and spending money at restaurants and to bars. And so this is another indicator of consumers are being resilient. Even though they may have a little bit less money, it seems they're still spending. And so this is causing more inflation, more sticky inflation. So still, it's another issue on top of, I didn't report it here, but the jobs report came out very inflationary as well. So what I am suggesting, or what I am saying is, Mr. Jerome Powell here has a very big decision in terms of what he should do going forward. It seems like everyone is saying that next month, November, probably not going to raise rates. That seems to be the consensus. But there's thoughts of maybe the Federal Reserve will raise rates in December. So I suggest everyone to go look at the speech he's going to make tomorrow about this, about all these recent reports that have come out, kind of get a gauge of like what the Federal Reserve wants to do going forward. Because as I had shown on a previous presentation, that if rates go up, housing payments go way up, people are going to have less money. Maybe this causes inflation to go down, but also you're going to put a cripple on the economy. And so maybe we get closer and closer to a recession. So very important to know. I encourage everyone, go look at his speech tomorrow. Luke.
So why are consumers still spending money? I still don't understand. Is it going to change?
So part of it is, I guess, the idea of like a lot of people think that they don't really have a good place to put money. Inflation is high, so if you hold it, you know, you can't really, it's just going to lose to inflation anyway. The housing market is so high that a lot of people are scared to really buy homes. You know, a lot of people, they think, although technically the stock market is up for year to date, a lot of people have the idea that we're going to be going into a recession, or that the stock market isn't really the best place to put money. And so what does that leave people with? They kind of are looking around like, where should I put my money? And so people are deciding, well, instead of, you know, keeping it right now and like letting it go away to inflation, I guess I'm just going to spend it right now. I'm going to go get food. I'm going to go buy goods. I'm going to buy things online. What the miscellaneous store is like, it's like bouquets of flowers. It's just like random small shops. So that answer your question?
Yes.
Somewhat. Okay. A lot of it is also like, we're kind of the Federal Reserve's kind of throwing up its hands of like, they just keep spending money. I guess that's the American way, isn't it? Okay, so like I said, everyone check out the presentation that Jerome Powell is going to make tomorrow. I am curious to see. I will be reading it myself. Sebastian? You know, I don't actually know. I just know he's going to make a speech tomorrow.
It just said in the afternoon.
Yeah, you know, on his own time. He's kind of old, slow, takes his time. Okay, so now I'm going to kind of pivot a little bit, talk about what the inverted yield curve is. Does anyone know what the inverted yield curve is? Anyone that's not an MD? Sebastian?
It's essentially when the 10-year treasury yield are now larger than the short-term around 2-year yields. And so it's basically like the short-term outlook on bonds is worse, and then the long-term 10-year yield is usually like more predictable. You don't know what's happening, but you're expecting the 2 years to be, you know, essentially worse.
Okay, so not quite. It's actually kind of almost the inverse of like the 2-year has a higher yield because people think that, you know, inflation is high now, rates are going to go down. So you can't give out higher rates if the federal funds rate is going to be lower in the future, which is what people think. So this is a normal yield curve. So it's the inverse. So it's like people think that the future is going to be better than today. You're going to get more money on your cash if you invest long term, and the rates are either going to stay the same or they're going to keep going up. And so there you go. It's a normal yield curve, but the inverted yield curve is different. It's actually the further out you go, the lower the interest rate you're going to get. So right now, if you have a 2%, you're going to get a higher yield than the 10-year because people think that inflation is going to level off. At least that is the idea. And so that's factored in of like, if you average out, you have 2 high years of inflation and then lower years, you're going to get the average of that roughly. So you can see here, you can have a normal yield, you can have like a flat yield where people think pretty much that cash is going to be relatively the same.
What's the best time to buy bonds? Is it like when the market is down?
The best time to buy the bond is whenever you think that the bonds are mispriced and you happen to know that these geniuses that are running the bond market are incorrect, which is almost never. But if you think that rates are going to be going down and rates are high right now, then that would be roughly when you should buy a bond. And so I just kind of wanted to show what it is currently. We can see it's pretty high right now. It's going to continue to go up a little bit as people think there might be a chance that we raise the rates 1, maybe 2 more times. And then it's going to start to go down as inflation goes down. So this is typically seen as an indicator that a recession is coming because typically whenever you get an inverted yield curve, within 12 to 18 months, you get a recession. This has been predicted. I believe it has been correct 6 times. But it has only been one false positive ever. And I am going to give it up to Professor Sweet, who has a presentation roughly on the inverted yield curve.
All right, I'm 3 for 3. I wrote a blog again. So like 3 of y'all gone and read it. So I'm like up 70% over last year. So I read this article in The Economist. I thought it was interesting. Here's the typical yield curve. It's not quite as smooth as what William showed. I've used the actual numbers. So what you'll notice is there's usually a kink around 1 year, a little bit of a jump up. Usually one around 5 years, and then it's pretty flat once you get out to 7 or so. But that's the typical yield curve. The 10-year is usually 60 basis points higher than the 2-year. That's the norm, 60. So keep that 60 in mind. If the 2-year is at 4%, the 10-year would normally be at 4.6. All right. Why is that? So y'all have had this in money and banking. Y'all remember this? Why does the yield curve have the shape that it has? So the theory that you hear the most is expectations. The yield curve just reflects what people think the rates will be in the future. So essentially the 10-year yield should just be what people think the 1-year yield is going to be the next 10 years. The problem with that is if the yield curve is upward sloping, then that means the market normally thinks rates are going to rise. But is that true? The people most of the time think rates are going to rise. So there must be something else going on there. But the yield curve, the wonderful thing about the expectation theory is it does predict what they think rates are going to be. And if you disagree with them, you can do a bet against them. So whether there's other things going on, you can always bet. If you think rates are going to be higher or lower, you can do a long, short transaction. So you can actually bet on your theory. So that's the expectations theory. The liquidity preference theory just means people just prefer to be in certain places. So most people might prefer to have shorter term because it's more liquid. There's not as much uncertainty. And there's some risk, you know, you go out 10 years, inflation could take off, all these things could happen. You go out 2 years, yeah, there's not as much risk. So that may explain why 10 years normally pays higher than 2 years, because you're getting paid a liquidity premium or kind of a term premium. The market segmentation just says there's a supply and demand. Some people want one thing versus another, and so that's explaining it. There's just a mismatch. And then same thing, preferred habitat. People just prefer being certain places because that's where their assets are. But you'll learn this, what, in money banking, right? Don't you learn it in money banking, or is it in macroeconomics? Somewhere, you're gonna learn it somewhere. And there's other theories out there. So here's the yield curves that Wheeler was talking about. Here's the one of last week. And here's the one July. Look at the 10-year versus the 2-year there. Look at the 10-year. So has the yield curve gotten steeper or flat or more negative? Is it steepened or is it flattened or negative? I can't think of the term for negative did, but do you get steeper or go more negative? From July to, is the difference in these two a bigger number or a smaller number? So it's actually steepened. It's still negative, but it's steepened. Does that, can y'all kind of grasp that? It can steepen mean what? The difference between the 10 and 2 is not as wide now as it used to be, but it's still negative. So it was 108 basis points difference here between the 10 and the 2. And today, well, when I did this, it was 36. The difference between that and that is, as of today, it's actually down to 28. But it's negative 28. The normal is what? Around 60. Right now we're negative 28, so we're still negative. So is that good news? That's what that Economist article was. So the yield curve is negative, but it's not as negative as it was. Is that a good news? So look back at 1980. The yield curve was negative 241 basis points negative. And it steepened really fast. It was 100, positive 100 basis points a year later. So what happened in 1980 that didn't happen this time? In 1980, so how can this thing steepen? It can steepen by what? The short end coming down or the long end going up. In 1980, guess what happened? The short end fell. When the short end falls, what does that mean? The short end was rallying. Interest rates were falling with short end. That's called a bull steepening. When the short end rates come down, that's a bullish sign. That's good. It's great. That's what we like. Is that what happened here? Did the yield curve go from negative 108 to negative 29 because the short end dropped? Y'all see the short end dropping? There's July, like a couple of basis points. What did it do this time? What kind of steepening does that have? If the short-term rallying is called a bull steepening, then the short end, the long end selling off is called what? A bear steepening. Does that sound like a good thing to you? So there's the Economist article. If any of y'all want it, let me know. I'll send it to you, or you can just read it on the YouTube. They said we've had 3 bear steepenings in the past. 1990, 2000, 2008, 1990, S&L prices, 2000 .com prices, 2008 financial prices. Does those sound like good times? Those sound like good times. As I said in my blog, the bond market's unhappy for good reasons. This is not a good omen. What is Jamie Dimon saying? We should all be hiding under our beds. You should have 20 cans of beans in the pantry and a bunch of water. So the world's coming to an end. Who knows? We've never been right before, but the last 3 times is pretty ominous. And the other thing they mentioned is it almost doesn't matter because interest rates are higher. And that's always brutal for a lot of people. So someone is asking, should I buy bonds? I like bonds right now. I hated them in 2020, but they're kind of a pretty decent place to go. Now, if you're an investor, this is kind of good news for you. If you got some cash, you want to invest. But interest rates going to be higher, interest rates for corporations will be higher, interest rates, I don't know if you've seen projection for the US government. But in a few years, about 100% of our budget is going to be paying interest on the national debt because there's not going to be any room for anything else. So it's pretty scary, the numbers we're looking at. So that by itself is a negative. It's great for banks, right? Because they make a lot of money on auto loans and they're not paying anybody anything on savings, but it's not great for anybody else. So I just want to leave you tonight with this idea that things are pretty horrible, but they're really not. In a couple of years, we'll be out of it, everything will be fine. So the question is, will a great buying opportunity come? And if so, when? And my answer is yes, and sometime in the future. So that's my forecast for you. Any questions on any of that? So go to my blog just so I get more counts, all right? So I'll give you a free piece of candy if y'all go to my blog. So, all right, that's it for me.
All right, we got a few more updates, and we'll let you guys go. So we have a good amount of events coming up in the next month or so. We have a happy hour mixer next Wednesday. So if any of you guys want to go, you don't have to be over 21. We're gonna go to 54th Street. If you guys, we're gonna leave from here after the meeting. So if you guys ever need a ride, if you guys want to ask for a ride, like some of the officers are open to give you guys a ride as well. So if you're down, you can come and speak to us after this meeting or next meeting, and we can provide you guys with a ride and transportation. That'll be next Wednesday at 9 p.m. So after our meeting. Then we have a women in finance panel coming up. That'll be November 2nd. So in 2 weeks at 6 p.m. We're getting a UTSA alumni, Investment Society alumni that's working at Blackstone. She's a principal and a portfolio manager at Blackstone, so she's pretty high up. The other two are from Goldman Sachs. One's doing impact investing and one's doing risk management. So it's a great event to go and learn about the different industries, about their challenges and their background. Not only if you're a woman, men can go and join in as well. I'll be listening in, not just because I'm the president, but I actually would probably get something out of it. So men, if you guys are interested, go and join. In November 8th, we're having the SWBC Investment Services CEO. It's not at 6 p.m. It's at 7:45 actually. And it's not going to be in this room. It's going to be in the first floor of the business building in a much nicer room. And we'll post that on our Instagram. And then we're going to do a mock interview and elevator pitch night. I think next week or so, we're going to get an RSVP going for you guys who want to practice your interviews, get the elevator pitch going. It's very important when you're interviewing, you have this elevator pitch. They're usually going to ask you like, all right, walk me through your resume. Tell me a little bit something about yourself. And you really need to have that down, because what that first question is really going to set the tone for the rest of the interview. So you can come out that day and we can practice it, set up your elevator pitch for you. We're going to do a resume and internship night November 16th. So that'll be in the FSC as well at 6 p.m. What we're going to do there is, you guys can bring in your resumes. We'll give you guys advice to updating your resume. You guys are looking for internships, want to learn more about internships, how some of us got the internships, how the interviews process was. We'll share that with you as well. And then the Professional Businesswomen Association is having a networking mixer on November 27th. So they're bringing in some of their alumni and to come and speak on, or not speak on, but they're going to be there, and you can network with them at several different companies, and it's going to be a cocktail style event. So it's going to be a business professional. You go in the HB ballroom at 6 p.m. and you can go in and network with different students or different alumni during that time. Same week, we're having our fall formal. That's what we do every semester. We have a fall formal and a spring formal, and that's going to be business professional as well. So we're going to be celebrating our graduates that are graduating, the new officers, and the scholarships that we give out during the semester as well. Again, this is fall 2023 classes. We had our analyst program today, and tomorrow is the CFA exam walkthrough at 5 o'clock in the FSC. So if you plan to take the CFA exam in the future, you'll be going over the CFA.
Next week, the wealth management. help you build a budget.
Yeah, yeah,
Mine's the next build. You never done the budget, you need to learn how to do it.
yeah. So next week on Monday is wealth management at 4 p.m. in the FSC as well. So if you're interested in the wealth management industry, you guys can go to that class and learn some more. I know they're thinking of bringing in a wealth manager for their last class or the second to the last class. Fit them in there to kind of tell you guys about the industry and what they do as a wealth manager. All right, this is our schedule for October 23. It's a little messed up, but you can see that we have the general meeting on October 25th, and then on November 1st, which is we still have our general meeting and Women in Finance panel at 6 p.m. on Thursday that week, and then SWC Investment Services mock interview second week. So we have a busy November, and it notes it's finals. It's also the last exams you guys will be taking. It's gonna be busy, but I recommend coming down and getting something out of these new professional development initiatives that we're kind of offering for you guys. Then November 15th is elections. So this is going to be, it's going to depend on you guys. I don't want to like spoil it, but we're thinking of changing the officer positions. We're going to try a new meeting structure and next week. And so if you guys like the new meeting structure next week, which is going to be a little bit different from like presenting market news, it's going to be more about like the technical aspects within investing and investment management and asset management. So next week we're going to be talking about an introduction to investing. So like, what is equities? What are bonds? What is real estate? How do you invest in real estate? What are commodities? Like, when would you invest in these certain things, and why what are the return aspects within those, and also like diving into like the capital structure of firms and whatnot. So we're thinking of doing that next semester where it's more technical aspects, maybe providing you guys with a little bit more value. And so if you guys, we're going to do that next week, and we want your feedback next week. So let us know if you like that style better, or if you like this current style we're presenting market news. So next week we'll put up a poll for you guys to vote on which style you like better, and that'll kind of determine the elections in the future. And then we had that resume internship night, 16th, and then obviously the PWA, Professional Businesswomen Association Network event at Fall Ball at the end. That concludes our semester. So market watch updates. Ihan, I'm not sure if I'm saying that right, is up 10% with 5,000 in total returns profit. Then Jay Wright coming in second, and Rua Medina coming in third. So Ihan is up pretty good, but there's still about, I think, like what 30 something days till the end of the market watch. So there's still a possibility to get to third place and above to win that prize. All right, society merch. We have that. We have the t-shirts here. So if you guys are interested in looking at the t-shirt or buying a t-shirt, our polos are coming in about 2 weeks or a week or so, and it's on sale after every meeting. It's also, you can find it on our website. That's it for us today, guys. I hope you guys enjoyed.